And then
Alrighty. I want to tell everyone, thank you, ladies and gentlemen, for joining us. This is Carlo Turner with the CEO Investment Fund, Mortgage Note Investing, of course. And this particular segment is for professional investors who like to invest into the nature of mortgage notes investments, but to offer you a new type of diversity of how you can utilize funds in the case that you're not liquid. You may also have an instrument known as an IUL policy. And I have a guest on with us to show you how you can benefit both worlds, not only gain the benefit of utilization of an IUL for you or your family, but also utilize this for investment purposes. And I think you'll be very interested to know how this is possible. As my guest, I have Nicole Rapport with me. How you doing, Nicole?
I'm doing great. Thank you so much for having me on your call today.
Yeah, I'm very grateful. I know you're busy, and for you to cut out some time to have a schedule with me, I am extremely excited. Just so everyone knows, Nicole Rappole is with Meraki Financial Solutions. She is one of the principals and one of the founders, and she is also an insurance broker, I'm very happy to say. So we have a person that is very experienced, and by the way, she was moving in this industry through the pandemic time and still being successful. So I'm very honored to have you. Oh my gosh, what a treat to our audience, what a treat to this channel, and what a treat to me personally. I look forward to learning some things. So I want to cut right to the chase, Rapol, if I may. And first of all, is there any, before I get started with this, any exciting news you care to share with us about IUL industry or anything that you can share with us just as a moment to
Yeah,
talk a little bit
absolutely.
about yourself?
IULs, IULs are becoming very, very popular. For the longest time, we called it, a financial loophole that a lot of people didn't know about. Back in the day, the Rockefellers founded a bunch of their wealth using index universal life policies, but they weren't very, very popular, and with good reason. Back in the day, there was not so many regulations when it came to using your index universal life policy. People would overfund their policy like crazy, borrow against a policy tax free. And then, of course, government Uncle Sam was like, wait a second, you guys are getting, death benefit tax free. You're getting money that you're borrowing against a policy tax free. We have to look at this. And that drew the attention of a lot of people because they're like, wait a second, whenever the government gets involved in something, obviously it must be good. So more and more people are now educating themselves on it, seeing that there's several different ways to use your life insurance. And it's not only when, that day comes that we go home, but also while you're still alive, you can absolutely benefit from using an insurance policy.
Nicole, I got to tell you, I've seen a lot of YouTube channels, a lot of YouTube pop-ups, just surfing the internet from time to time. I've seen guys on there talking about utilizing IULs to buy cars, IULs to buy stocks, bonds, what have you. And then even myself, being a fund manager of the CEO fund, which is also a private investment fund, uh, I've gotten these questions from investors about this, and I wanted to make a presentation about this. I keep being asked about it. Are you going to do a presentation about the use of IULs? Because for the guys that are not liquid, perhaps we can invest with you in some capacity by utilizing this. And so I'm very excited to have you here. I want to let you go ahead and do your thing. And I want to start with one question, if you'd be so kind. I'm going to ask you three today. I'm not going to keep you long. But the first one is, what actually is an IUL for our audience? Would you please elaborate?
Of course, yeah. So an IUL, it is a type of permanent life insurance, meaning that there is a cash value component alongside with a death benefit. It also, a different key point that I like to point out from a whole life policy that a lot of people are familiar with is that you actually get a lot of living benefits, which many don't have. And that's really important for people, that do have families. On top of the investment side of things, you also look at it as an avenue that if, God forbid, your medical insurance doesn't cover something, you have something to back you up. And then, of
Wonderful.
course, God forbid something happens to you, then your family does get a good chunk of change that it can use and build that generational wealth. But it does use the index that the insurance selects. So we have different ones that, that we utilize as far as like participation credits. We look at S&P 500, there's the US Pacesetter, NASDAQ. I mean, there's different investment strategies that you can use. But the good thing is that it is fixed. So,
Yeah.
with things like 401ks, IRAs, mutual funds, bonds, stuff like that, You fully go up with the market, but then when the market goes down, as a lot of people saw during the pandemic and even after, all those accounts also went down. With the IULs, majority of them do have caps. They go anywhere from like 9.5% to like 12% for majority of them. And yes, although you're not going and participating fully in the market, like all these other accounts go, the trade-off is that you have what's called a 0% floor. So even if the market crashes, things go below zero, your policy stays at zero. So although you're not earning a lot of money, you're also not losing money that you do have in your account. So that's something that I honestly prefer because it's a safe place to put your money. And not only do you get those interest rates, but you're also getting, your living benefits and a death benefit for your family.
All right. Well, wonderful. Well, on that point, I know that you have a presentation. I would like to see it where you're
Yes,
going to go further into the IULs, and I'd like our audience to see that. I'm excited. I can't wait to see what you're going to show us.
absolutely. So I wanted to go over an index universal life policy being utilized as infinite banking. There's a ton of videos in the internet, TikToks. So I
No, I
wanted to,
know.
go over the information. So
Okay.
becoming your own bank, what that means is, we'll go over the infinite banking definition, the role that life insurance has in it, of course, because it is a life insurance policy at the end of the day. The policy loan, which is when you're able to borrow against your policy, and we'll go
Excellent.
over some advantages, disadvantages,
So
and
I'm going to interrupt you just a second. So to be clear,
no problem.
so you can borrow against these type of policies.
Absolutely. So you
Continue.
can't borrow from your cash value, which is a big point that I do want to make. Is your cash value that you have plus the interest that obviously your account's growing in.
Very good.
But we'll go over that. So infinite banking is just simply where you become your own bank, utilizing an insurance policy, whether it's a whole life insurance policy or the way that we're going to really focus on and emphasize today is the index universal life policy, when you can borrow against your policy to fund major expenditures, emergencies, investment opportunities in this case, which you mentioned that we're going to be focusing on. As we may know, traditional banking, of course, makes it very, very hard to borrow loans and being able to use money. Not only that, but also the interest rates that you're going to experience when you do borrow from the bank. And then they do things like credit checks and they really look into a lot of things.
Yes.
Whereas with an insurance policy, it is health based. So most of the times you don't need a physical. Sometimes you do, depending on what's in your medical record, but there are several different companies that do accept several different conditions. That's where I would come in, to see what that would look like and what's going to fit you best based on your health that we
Bless
go.
you. Bless you. That's wonderful.
uh,
Continue. Thank
No
you.
problem. So, like I mentioned, the role of insurance, it is insurance at the end of the day, but infinite banking is not traditionally used for the life insurance purpose. Usually, whenever you are looking at an insurance policy, you have a set death benefit in mind that you want for your family members, whether that's, hey, I have several different mortgages. I want to make sure if something happens to me, my family doesn't have to worry about that or go to probate court to decide,
Yeah.
how much money is going to that from that fund. But the way that we do it for infinite banking is called a minimum death benefit with maximum accumulation. What that means is that we're going to keep your death benefit as low as a company allows. So that way, majority of the money that you're funding to your policy every single month or yearly, and most cases for investment purposes, goes towards your cash accumulation.
Wow.
Because it is your cash accumulation that's going to receive that compounding interest, and that is the money that you'll be able to borrow against your policy.
Phenomenal. That is phenomenal. My gosh. Wonderful. Continue, please.
Absolutely. And I did want to, go over a little bit about the policy premiums. You are still paying
Please.
for obviously insurance, so you do have a death benefit. But again, majority of the money that you're putting towards the policy is going towards your cash accumulation when it comes to infinite banking and the way that you want to utilize it. So the policy loan, this is where you actually get to utilize your policy. A lot of the times you do have to wait at least a year before you're able to borrow against your funds, unless there is a rider where you can access the funds earlier, or unless you pay annually, it does become easier to borrow against the policy. I believe mainly is because you do want to make sure, a lot of these index strategies are point to point, meaning that they'll go from the beginning of the year to the end of the year. they'll average out how the interest, played out, and then they're going to apply that interest to your policy. So usually they need at least a little bit of a period of time to decide, what the return on that will be. And I have an IUL myself, so we do get statements. You stay updated with your app, your portal, whatever the case may be, and then you can see
And of
how much
course, I know that too,
policy
because
has
I'm also one of your
earned.
clients. So I know
Exactly.
that.
Nice.
Continue, go
That's
right
great.
ahead. Thank
No
you.
problem. So when you borrow against your policy, the really cool thing about it is that technically, whenever you're borrowing from your policy, because it is seen as debt, you don't pay taxes on that. So you can borrow from your policy tax-free and you don't have to pay it back. Now, if you want to continue the interest rates, growing at a fast rate, you don't want your policy to ever lapse. I do recommend that you put that money back, allow for it to grow, borrow from it, pay it back, borrow from it, and pay it back. And then obviously that's when the infinite banking concept becomes a thing. So when you borrow from your policy, the interest is still growing based on the money that was there before you borrow from your policy.
So
So
it
that
is
means
still
that
compounding. The principal is still compounding.
correct, it's still
Very
compounding. And you will get charged an interest for borrowing from your policy, but the interest, that's already there is going to offset whatever it is that you have for your interest from borrowing from that loan. So although it's not growing at a fast rate, because there is that, negative deduction from your interest, you're still growing your policy, even though the money technically is not there. Now, let's say you pass away, God forbid, you're not able to pay that policy loan back. What they're going to do from the company is that they're going to deduct whatever you borrow from your policy from your death benefit, and then your family will get the remaining balance after that.
beautiful, beautiful, beautiful.
All
This is one of the
right.
most phenomenal things about an IUL that absolutely every investor should look into this, and particularly call Nicole Rapport. We should give her a call. Continue, Nicole. Thank you.
Absolutely. So advantages, like I mentioned, liquidity traditionally, especially if you're using this, let's say later on you decide I'm done using it for investments. I actually want to look into retirement now. I am self-employed. I don't have a 401k. So now you're looking at liquidity. Most of the times accounts do wait for you to turn at least 59 and a half or 65 years old before you're able to access those funds. Otherwise, they give you a tax, penalty and also penalty fees for, accessing the money earlier. So this gives you liquidity to be able to borrow against your policy way sooner than that. And it also protects you against volatility and gives you certainty. So obviously the market fluctuations, we never know when they're happening. We came from a recession, now there's tons going on. And the good thing is that with this, you don't have to worry about losing any money because of that 0%
That's
floor. And
beautiful.
then the control. So the tax advantages, free withdrawal, asset protection from any seizures, judgments, protection from creditors. Because at the end of the day, it's not a bank account, it's a life insurance policy. So there's only so much that they can do, and you're protected on that end. And of course, cash flow and legacy. If you decide to wait on this policy, you can pay yourself a salary, whether that's monthly or yearly, later down the line. And the legacy of having life insurance, you're taking care of your family, God forbid something does happen to you. I do like to highlight disadvantages also. I mean, with the disadvantages, qualification has to be the biggest thing. You do have to be in good health, but there's also, different loopholes and ways that we can always make things happen within legal legal abilities, right? I want to
Okay.
make that clear.
Okay.
But there are little things that we can do to make sure everyone has the opportunity to and be involved in one of these policies. The cost in comparison to traditional life insurance, of course, you can get a term if you're, good health and you're young for tons of money. But again, terms end, you have nothing to show for it. So it is a good plan to have if you're, covering temporarily. And then the mindset of investments. Anyone that is watching this, of course, has that investment mindset. So I won't go too much into detail with this, but obviously you
Right.
have to put money somewhere, give it time,
Well,
allow for it to grow. It's not a
absolutely.
get rich overnight thing. It's a more like a long-term play, but it is fixed.
One
It is
thing, one thing I
protected.
definitely see, even for myself, I noticed it immediately, and something that some of the viewers should notice immediately. My gosh, you're not going to get this type of advantage sitting in a savings account. It's just not going to happen. You're not going to get this type of advantage being in a money market account, even though you get a decent interest. But this type of advantage that protects you against the fluctuation of the marketplace, and in addition to a zero floor, oh, this is beautiful. Because even in a money market, when the market goes down, they drop the interest rate on the money market accounts as well. So this is an advantage. By the way, similar to the fund I run, we're not affected by fluctuations of the market. So an investor can have the best of both worlds, being in the policy and also utilize the policy to
Absolutely.
invest from what you're saying into other opportunities, still getting compounding interest in the policy, and also getting profit share or interest return on investment on whatever else they diversify the funds into when they borrow. Is that correct?
That's correct. And the good thing too
Absolutely.
is that, I'm always here also. You already know that. So if you ever needed anything
Yes.
with the policy, we can always make changes. If you say, hey, I feel like I could have a better return on this money, we can always look at the investment strategy that you're currently a part of. You can always change it. I recommend doing it once a year. But if you say, hey, instead of putting, 50% in the S&P 500 and 50% in Barclays, for example, whatever the case is, I want to do, 100% in this investment strategy, whatever you want to do, we can always change that to make sure that it fits exactly what it is that you want to do with it. So
Oh, that's beautiful. Continue.
you
You're
have
doing
that
good.
ability.
This is wonderful. Very
Yeah.
impressive.
So, um, really the next part is like how to get started. So in that case, we would then do, depending how much money it is you want to fund your account by, there are certain limitations of how much you can fund it by. And also you do have to realize that, I'll just go over what the MEC is. The MEC
Sure.
is a modified endowment contract. It basically tells you what the max amount of money it is that you can put into your policy before it becomes taxable. And the
And is
way
that
to,
subject to age on
what
each
was it?
case?
Oh, I'm sorry.
Is it subject to a person's age in each case?
It all is based on your death benefit. So because we are doing a minimum death benefit max accumulation, they limit you on how much money you can put into that account because they also have to make up for the cost of insurance. So if your death benefit is higher, your MEC limitation becomes higher.
Okay.
So, I mean, I can give you an example of one of the companies I work with just to give you certain numbers of
Sure.
like, we can pick like someone that's, I don't know, however many years old.
Okay. Thank you.
Uh, yes, no problem. Let me pause this real quick because I will be logging into my back portal and I want to protect clients' information. So
Okay. All right.
give me 1 second and then we can cut this and get to
Sure.
it. Alrighty, let's,
All of this, I'll edit this year.
okay, perfect. Uh-oh, go open this up.
I can sit and listen to you talk all day. You are really smooth, very, very comfortable. It's very,
Oh,
very
thank you.
make everyone feel very comfortable. I
I
noticed it
appreciate
immediately
that.
when I met you. I said, "Oh my gosh, this has got to be the coolest insurance person I've ever met in my life." My gosh.
Thank you. I do appreciate that because the biggest thing that a lot of people run into is, they're, um, you know, getting that sales pressure from a lot of people. And I always try to make sure that I'm not ever that person.
Good job. Good job.
Thank you.
Those are some wonderful points. Particularly loved the tax-free element of what you were talking about. It's wonderful.
Yeah, there's so many advantages people don't realize. And I know they're becoming more and more popular and, more people are talking about it, more agents are doing it. I just want to make sure everybody, is careful whenever they're dealing with somebody.
But I've heard some horror stories out there.
There are, which I'm
Yeah,
sure,
some people
you
who
know,
have run into some agents who claim they know how to do this,
mhm.
and people move the money, and it was not anything remotely what they thought they were getting.
Yeah,
It's
so
really excited about how in depth you went, the clarity, the carefulness about this. One thing I do want to ask you while you're pulling up that,
yeah, sorry about that.
no, it's
Like,
quite all right. You have a website for Meraki?
I do. I
Good.
will send it to you once we get off this call. And
Okay.
it has a booking link so people can make appointments and all that
There
good
you go.
stuff.
Nicole. Very good.
And I'm slowly growing the Meraki Instagram page, but
Okay.
I do also have some like small short videos that go over IULs and mortgage protection, all that
Okay.
other good stuff.
Very
So
good.
we'll go over that. All right, let's see.
Wait a
Gmail,
minute. Did you say mortgage protection?
yes.
What?
Which is something I was gonna bring up. Yeah, mortgage protection is basically, you can do three kinds actually using a term policy. So instead of like going through like a mortgage company, they usually have insurance. They only cover the mortgage. But what I do is I'll take term policies, whether that's like a decreasing term where, as time goes by, let's say you have a $300,000 mortgage and you have a $300,000 policy, every year that term policy goes down and it gets cheaper to match your mortgage. So as your mortgage goes down, it also gets cheaper. So you're paying for a term that's decreasing. So if you have like a 30-year, $300,000 mortgage, I'll match it. Or you can just do a term where either A, you get cash back. Those are a little tougher to get approved for, but basically, let's say if you have like $100,000 term and you're paying $150, it's more expensive than that. But let's say you're paying $150 at the end of that term, the term will expire, but then you get either 50% of all your premiums paid back or 100% of all your premiums paid back. There's that, and then obviously a regular term, which is really cheap, where you can cover, like I'll do, for example, a $300,000 term for 30 years, and then in case something happens to them for that 30-year term, then their family gets $300,000. So I use it as like mortgage protection. I know, right? Insurance can be used in so many different ways, people don't realize it. So that's what I focus on is what are, creative ways to use it. All right, I
Thank you.
finally logged in.
That is amazing. Gonna have to talk to you more about that off
Absolutely. I
camera.
would love that. But yeah,
Is
I can show you how it
there any
works.
limit on the size of these mortgages? What if the mortgage is larger than 300,000? Much larger.
And I mean, with NLG, the company that you have your IUL with, and I have mine too, you can go up to like 10 million. There's they don't have cashback options. Cashback options only go up to 450,000, but all the other regular terms, I mean, I've written, I think the biggest term I've done so far was 7 million, and it was a business owner that wanted to cover, and he made his key person, like his business partner, um the beneficiary, and then God forbid something happens to him, then the business is functioning for another couple years until they can like figure it out. So there's a lot out there.
Well,
uh
I'm so happy to meet you. I don't know what to do. My God. Thank you. All right, I'm ready when you're ready.
no worries. Yeah, I'll open up an illustration just to give you an example so we can use.
So we're still at question number two. How do you structure this
I
IUL to
think
pay
I went
for?
over question 3 also, which is how to utilize a policy. So
Yeah,
um
you
we
did.
can go over that again, with this. So let's do Florida. All right, I'll share my screen again.
Thank you.
So yeah, no problem showing this. But for example, here we can say, it automatically went to a male 45 years old in Florida. So we'll go, death benefit and funding. Let's say, give me an example of how much money someone would want to pay monthly or let's say yearly, because then that way I can have a better, give me, I don't know, give me a monthly first. Let's go monthly first. Someone wants to put in how much monthly?
Okay.
Give me an example. Uh,
Let's say 25,000 that they want to put in. No, let me reduce this 10,000 that they want to put in monthly.
Monthly.
Yeah.
Okay, 10,000. Obviously, that is a bigger amount than what most people would do.
Okay. What would
So
most people do?
I'm saying like as far as like a client, like just a regular client I'm talking about or talking to, not like a investor per se.
Oh,
But
gotcha.
what
All right.
ends up
So
happening
about
here,
$500 a month.
yeah, something like that. But we can use an example of, 10,000, just to give you an idea of what that would look like. Obviously, the
Okay.
death benefit needs to be
If you would, I prefer you use 500.
500. Okay, no worries. We can backtrack then. All right, so let's say 500.
Okay.
Okay, so we're looking at $500 monthly. So just a quick overview with $500 monthly, that's $6,000 a year. As
Mhm.
you can see here, your death benefit, and this is again based on a healthy 45-year-old, their death benefit would be at 276,000 in the state of Florida, which the state doesn't really, make a huge difference. But the plan premium would be 6,000. Out of that, the accumulated value immediately is $4,300. Now, like I mentioned, the first year you wouldn't really be able to borrow against the policy unless we put a rider on this policy, which we can absolutely do so you can, utilize it. But any money that you overfund your policy by, and overfund, I mean more than the $500, would immediately go to the accumulated value that you can borrow against later down the line. So for people that are using this, for retirement, for example, at age 65, this person, worst case scenario, this is based on the market right now, which I believe is at like a 6.40 something.
Mhm.
If the market wasn't ever to change whatsoever, then worst case scenario, they would have, $191,000 that they can borrow against.
My gosh.
And
Depending
then
on the way the policy's set up, they can get 50%, 60%, 70% of that money.
correct.
Okay.
Yeah.
One
Well, this
question I do have for you, you mentioned a
yeah,
rider of because they wouldn't be able to borrow in the first year unless they have a rider. Would you explain for our audience what a rider is so those
a
can?
rider is basically saying like a stipulation. So, the company will add it. They might, charge you like a percentage, small percentage interest on the back end. But what you can see here is that now by adding this rider, instead of, this being zero, immediately you already see that the surrender value matches the
Mhm.
accumulated value. So that means is
Mhm.
that now I have access to this money a little bit earlier. Uh,
Mhm.
that's not the case for, all companies, just using this one as an example, which is National Life Group. I'm able to add that rider to use it sooner. Now, if you
Good.
were to add any other money to this policy, then you can count on this going up more so than raising the death benefit. At that point, the cost of insurance is higher, so now lesser of the money is going towards the policy itself.
Excellent. Excellent. This is wonderful. I got to tell you, this seems like a very intelligent investment strategy for investors, an additional diversification to what they want to do in utilizing their funds. It just makes sense, Nicole, to go this way. Do you find that when you're presenting this to customers that they have a tough time comprehending what you're offering, or is this something that they seem to understand completely?
Yeah, most people that, especially recently, that have been inquiring about insurance, they've already have some sense of, oh, I saw videos, just like everybody. I was scrolling on TikTok and I saw this person talking about you can use your policy while you're still alive. And I just wanted more information. And then when you really explain it, they're like, oh, okay, that makes sense. Of course, there's a lot of bad information out there too. So that's why it's important that you have someone that's familiar with the product and does have a license to sell insurance and talk to you about insurance, because there is a lot of people that are out there saying, "Oh, you can, pay $100 a month, and then you're able to access your death benefit the next year." And obviously, that's not
Well,
not correct
fantastic.
information. So you also have to be careful. But at the same time, for everybody that sees it, really the biggest concern is usually qualification, and for obviously a lot of people to budget, because it is, something that it's an added, I don't want to say an expense, it's an added investment to a household. So, those are the two biggest things that I've run into. It's qualification, people that, could or could not qualify for a product like this, and then obviously being able to afford the product. That's the two main objections that I would see.
Well, there you have it, everyone. I want to thank you, Nicole, for this. This has been very informative. Very grateful for you to be with me in this particular capacity. Again, the name of the company, Meraki Financial Solutions. And
Yes.
you're going to provide us your website. And I want to definitely add your link there so that people can call you. Nicole, are you doing any presentations that are coming up, any speaking engagements coming up that our audience can know about, where to find you, how to find you, etc.?
Not yet, but I will be sharing with you, of any that I do come across. I love, educating people on obviously finances, and I do want to touch on this as a minority woman. There's a lot of people in my community that aren't aware of financial literacy, and I've made it my personal, I guess, like promise that I am going to educate as many people as I run into on this so that they too can set up their family and, build generational wealth with it, which is something that many people don't have the opportunity to do in other ways. And I think that this is a great way to start by getting life insurance. So,
I want to tell you, I think you're a champion in the community. Absolutely. And thank you for
yeah.
your conviction to educate more people about this. Generational wealth is something that I totally believe in as well. In fact, our investment fund, one of our primary themes for the CEO fund is building generational wealth because we can offer stability that most of the Wall Street products simply can't compete with us in. But this is a wonderful thing, a wonderful solution for many of the investors that we talk to or that we encounter that are not liquid, but have these type of IUL policies and did not know that they can borrow against them to invest into our fund. So I'm very grateful to have you with us. Thank you for your time. Thank you for this
Yeah.
wonderful, masterful wisdom you have conveyed to us today. And I'm very blessed to have you. Again, Nicole Rapport with Meraki Financial Solutions. She
Yeah.
is an insurance broker, not just an agent, an insurance broker. And she has the ability to meet whatever you need to have met in any circumstances or particular road bumps that you may bump into. She knows how to give you a solution to get that done. Nicole, I want to thank you. God bless you for your time. Have a wonderful day. And I look forward to having you back. Don't forget the small people.
Oh no, you know that. I'm not going anywhere. Like I told you the day you got approved, you're stuck with me as your insurance agent because now you have
Wonderful.
permanent insurance, you get a permanent life insurance broker. So I'm
Okay, well, that's wonderful. All right, I'm going to stop this
yes.
recording here. Let me figure